All right. Hello and welcome. Today we're tackling a big one, shareholders' equity. Now I know it sounds like some super technical accounting term, right? But honestly, just think of it as the core financial identity of a company. It's the answer to the question, after every single debt is paid off, what's actually left for the owners? We're going to break down what it is, where it comes from, how it changes, and why it is absolutely one of the most critical things for any investor to truly understand. So let's jump right in.
So here's our game plan. We're going to follow the life story of a corporation. First, we'll look at how a company's even born, legally speaking. Then, we'll follow the money as it raises capital. After that, we'll see how a successful company shares the wealth. Then, we'll check out the official financial scorecard where all this is reported. And finally, we'll get to the fun part, using these numbers to judge how well a company's actually doing.
Okay, so before we can even talk about the owner's stake, we have to understand the thing that's being owned. That means we have to start with the fundamental building block of it all, the corporation itself. Now, the most important idea to get your head around here is that a corporation is basically a separate legal person. Seriously, it can own things, it can sign contracts, it can sue people and be sued, all on its own. So what does that mean for you, the owner? It means if the company goes bankrupt, creditors can go after the company's assets, but they can't touch your personal car, your house, or your savings. This legal shield is a huge deal. And this whole separate person idea is what makes all these other powerful features possible. We just talked about limited liability. That's the big one, for sure. But think about transferable ownership. The fact that you can buy and sell shares on an exchange in seconds without any complicated legal paperwork is amazing. It also means the company has a continuous life. It doesn't end if an owner leaves. And all of this makes it incredibly good at attracting capital from tons of different people. Now, not all corporations are the same. You've got two main flavors. Public corporations are the ones you know, the Apples and the Googles of the world. Their shares are traded on stock exchanges for anyone to buy. But that access comes with a mountain of regulations. On the flip side, you have private corporations, which are usually owned by just a few people, and you can't just go buy their stock online. This difference is key for our next topic, how they get their money in the first place. So a company needs money to get started and to grow, right? But where does that initial cash come from? Well, it comes from selling shares, tiny little slices of ownership to investors. And this simple act of selling a piece of the company for cash is the very moment shareholders' equity is born.
In that first pot of money from investors, that's called share capital. You might also hear it called contributed capital. You can think of it as the seed money that gets the whole business off the ground. And legally, this capital is meant to stay inside the company, which gives creditors a nice little safety cushion.
Let's make this crystal clear with a quick example. Imagine our company, Hydroslide, sells 1,000 shares for $5 each. What happens? Well, the company's bank account gets $5,000 bigger, so we debit the cash account. At the same time, the owner's claim on the company, which we track in the common shares account, also goes up by $5,000. It's a perfect balance. Simple, right? But this is the transaction that builds the entire foundation of the company's equity. But hang on, not all shares are the same. Common shares are what most of us think of. They represent real ownership. You get voting rights, you get a say. Preferred shares are a different beast. Holders of preferred shares usually give up their voting rights, and in return, they get priority. They're first in line to get paid dividends, and if the company goes under, they're first in line to get their investment back. It really boils down to a classic choice. Do you want control, or do you want security? And that priority for preferred shares often comes with a very powerful feature called a cumulative dividend. What this means is, if the company hits a rough patch and can't afford to pay the preferred dividend one year, that missed payment doesn't just disappear. Oh no, it builds up like a debt, and it all has to be paid back before the common shareholders can get anything. And this slide really drives home how significant that can be. Look at this example for Scientific Leasing. Their annual preferred dividend is $35,000. They missed it for 2 years straight. That's $70,000 they now owe, what we call dividends in arrears. So now, this year, if they want to pay their common shareholders even $1, they first have to pay that $70,000 from the past, plus this year's $35,000. That's a massive $105,000 hurdle they have to clear first. All right, so the company has its capital, it's making money, life is good. So what's next? Well, now it has to decide what to do with those profits. How does it reward the investors who took a risk on it in the first place?
This brings us to the really interesting topic of dividends and other ways companies share their success. You know, paying a dividend isn't as simple as just writing a check. It's a formal process with 3 really important dates. First up is the declaration date. This is when the board of directors makes it official. The moment they do, that dividend becomes a legal debt the company has to pay. Next is the record date. Think of it like a snapshot in time. Whoever owns the stock on that specific day gets the dividend. And finally, you have the payment date. That's the day the money actually hits your account.
So, what if a company wants to reward its shareholders but maybe hold on to its cash for a big project? One option is a stock dividend, paying shareholders with more shares instead of cash. Now look closely at what happens here. The company moves money from its retained earnings account into its common shares account. But, and this is the critical part, notice that the total equity stays exactly the same, $400,000. It's just moving money from one pocket to another, basically signaling that those profits are now permanently reinvested in the business.
Now, don't get that confused with a stock split. A split is totally different. In this 2-for-1 split, look what happens to the equity accounts. Nothing. They are completely unchanged. All that changes is the number of shares. It doubles. The goal here isn't about reinvesting profits. It's purely psychological. It cuts the stock price in half to make it seem more affordable to smaller investors. You're not creating any value. You're just cutting the same pizza into more, smaller slices.
Okay, we've gone through a lot of things that can change a company's equity. Issuing shares, profits, dividends, splits. So where do we see all of this officially reported? For that, we turn to the company's main financial report card, the Statement of Financial Position, or what most people just call the balance sheet.
So when you look at a balance sheet, you'll see shareholders' equity broken down into a few main buckets. You have share capital, which is the cash investors originally put in. You have retained earnings, all the profits the company has kept over its entire life. You might also see things like contributed surplus, which is kind of a catch-all for other transactions. Looking at these pieces together gives you the complete story of where the owner's stake came from. I really want to pause on retained earnings for a second, because this might be the single most important number on this half of the balance sheet. Think about what it represents. It's the grand total of every single dollar of profit the company has ever made, minus every single dollar it's ever paid out in dividends. This is the earned capital. It's the engine that powers a company's growth from the inside out.
All right, this is it, our final section. We've learned all the pieces. So now let's put on our analyst hats. How do we take all this information about equity and actually use it to figure out if a company's a winner or a loser? Well, the answer is ratios. First up, we have the payout ratio. It's a simple calculation that tells you what percentage of the company's profit is being handed right back to the shareholders. But this number tells a story. A high payout ratio might mean you're looking at a mature, stable company that doesn't have many places to invest for growth. A really low payout ratio, on the other hand, could signal a young, fast-growing company that's plowing every single penny back into the business to expand.
Next is one of my personal favorites and maybe the ultimate profitability metric, return on common shareholders' equity, or ROCE. This is basically management's final grade. It answers one simple, powerful question. For every dollar the owners have invested, how many cents of profit did the managers generate this year? A high and consistent ROCE is a fantastic sign of an efficient, well-run company. And finally, the one you've probably heard of the most, earnings per share, or EPS. It's maybe the most quoted metric in finance. Look at the formula. In the numerator, we take the profit, but we subtract any dividends owed to preferred shareholders. Why? Because EPS is all about what's left for the common shareholder. Then we just divide that profit by the number of shares out there to get the profit for each individual share.
And that leads us to a crucial final thought to leave you with. Everyone loves to see EPS going up, right? It's usually a sign of a healthy, growing company. But you have to ask why it's going up. A company can increase its EPS in 2 ways. Either make more money, which is great, or just buy back its own shares to reduce the number of slices in the pie. So if you see a company's EPS climbing, but its profits are actually flat, what does that really tell you about its long-term health and its actual growth prospects? That's a question every smart investor needs to be asking.